My trade methodology. Below are the fundamentals of my methodology in points, including my overall trading philosophy, my system for risk and trade management, the actionable entry setups I use, as well as some tools for interpreting price action around critical levels. This is a dynamic page that will be constantly expanding. This newsletter is intended to be an ongoing education. In other words, every day I not only discuss my actionable trade plan and entry triggers, but also the setups I use and examples of them in real time, failed breakdown setups, etc., how I manage trades, and my general philosophy on trading. I illustrate these using real-time examples. Over weeks of reading, the concepts become clearer and actionable. Trading is a lifelong learning process and takes significant time investment in the order of thousands of hours. There is no shortcut to putting the time in. You are competing against the smartest people in the world, as well as sophisticated algos to prey on repetitive tendencies of retail traders, and you will not beat them without putting in the legwork and doing things very different from the majority who are destined to lose. The psychological foundation. I trade seldomly and in predefined windows. Overtrading is the #1 reason most retail traders never achieve profitability, and all professional trading is characterized by picking your spots, waiting for price to come to you, then being on the sidelines the rest of the time. I shoot for 1 to 3 trades per day. As Paul Tudor Jones famously said, markets, and therefore most trading days, are 20% trend moves and 80% chop, and the trend moves are typically before 11 a.m. and after 2 p.m., with the period in between being choppy and poor trading conditions. My trading window is 8 a.m. to 11 a.m. and rarely after 2 p.m. There are exceptions when volatility is higher, so this is a guideline and not a hard rule. An ideal day for me is getting 1 trade in before 11 a.m. If the first trade is a loss, I will try a second, but never more. If the first trade is a win, I will wrap it up until post 2 p.m. session. If I have a good realized gain, there is no reason to get chopped up or taking a loss to grab a second. My general rule of thumb is to try to spend 10% of the day in an actual full trade, around 30 minutes maximum trading per day, and the rest hold a runner passively, preparing charts, working on the trade plan, and waiting on quality. Trading is not a paid-by-the-hour job, the opposite. The less you trade, the more you make. The average trading day is typically comprised of 1 to 3 level-to-level moves and tons of unactionable, trappy chop. Trying to force trades when there are none is the cause of the vast majority of losses for new traders. The market is not a casino, and if you are sitting there all day flipping back and forth all day trying to get rich quick, you are doing the same thing 90% of retail traders who lose. Plan your trades the night before, wait for them, take only pre-planned trades, then shut the platform down for the day, and/or hold risk-free runners. 3. Small gains add up and compound over time, and trading is a long-term process, not a get-rich-quick scheme. My goal is not to catch every move, nor is to catch all of any one move. This is impossible and rarely happens, and it is very costly to try. The goal is also not to get rich in one trade. It is not a lottery. Wealth is built over time in markets by running a consistent process, stacking consistent, conservative daily gains, and harnessing the power of compounding. FOMO and greed are the primary barriers to realizing this objective for most new traders, and is the discontent with the sustainable, realized 10 to 15-point gain for hopes of rare 75-point jackpot that prevents sustainable account growth. I just want a good level-to-level piece or 2 a day, while adhering to a process that allows me to profit over a large sample of diverse conditions, and this is the path to true transformative wealth creation. If price moves 100 points in a day and I catch 20 points, I am very happy. Think in terms of base hits, not home runs. Do the math on 10 to 15 points a day on average over the course of a year, and one can see it adds up more than any home run ever will, for those patient enough to take it. 4. What I call the impulse trades are the primary barrier to profitability all new traders must control to see any sustained P&L growth, and my entire system and philosophy is built around not doing impulse trades. Fear of missing a move, greed, avenging a loss, boredom are not reasons to trade. My trades are all planned the night before. I know the zones I want to engage. I know the action around the zones I am looking to trigger myself to engage. Once I get my gain, I then protect it by not trading more. A huge chunk of unprofitable traders have all the skills and screen time to be profitable, but just can't sit on their hands. All the mediocre F-low and boredom-based trades destroy the gains from A-plus setups. Profitability is found on the sidelines on the trades you don't take. 5. Most price action each day is a defining skill of successful traders. There is no edge capable of catching all the price action on a given day, and trying to force action there is none is the cause of most losses. You should trade only because one of your pre-planned setups triggers in a pre-planned zone. When you have clear, high conviction, then you should be watching the rest of the time. On most days, if the above principles are applied, you may catch a good piece of the daily action. One of my mentors told me if he catches 20% of the total daily action, it is an A-plus day. You need to be comfortable with missing moves and being on the sidelines, and with the reality that there is no way to catch them all. If you try, you lose. It is being sidelined that most beginners struggle with. With some practice, hard work, and a few thousand hours behind the screens, most people can learn to 1. Pre-plan a high-quality trade in a high-conviction zone to take it the next day, and 2. Wait on it and take it. What very few can do, however, is sit on their hands after. The primary difference between successful and unsuccessful traders equals, and I truly believe is that the successful traders have conquered FOMO. They end up chasing price, overtrading, and, terrified of missing a move, end up taking a slew of mediocre 50-50 trades that destroy profits, create losses, then create a cycle of overtrading to make it back. You don't need to trade all day, and you will most certainly make less you do. Take your piece out and move on. Trade management, the most important part. 6. My trades are always level to level. This is the core to my edge. This is the entire core to my system and what drives my edge. What really drives my P&L is not the entry setup, but the trade management system, what happens after entry, and level-to-level trade management is the core of this. While new traders are obsessed with the entries, they won't make you profitable. You can have the best entries in the world, but if your trade management is not systematized, those entries will result in 1. You'll exit way too early, 2. You'll exit way too late, or 3. You won't exit, and you'll go from green to red. Level-to-level trade management means get in at one level, usually a pre-planned area that you waited on, then always take majority profits first resistance, leave a risk-free runner, then reset bias as if seeing the market for the first time. Do not get attached to any one forecast, as price will spoil all of them. Nobody has a crystal ball, and nobody can predict where the price will go. In the below paragraphs, I detail exactly how this is done in practice. As a day trader, where ES will be in a week, month, or a year, and how it gets there has zero bearing on your P&L, and nobody can predict these things anyway, and even if someone gets a broader target right, price will take such a convoluted, stop-hunting path there that you won't be on board anyway. What gets you paid is the next level-to-level move. Let the price unfold as it wants. Why do I trade level-to-level? This is because of what I call market math. Price only trends 10% on the time on average, with the other 890% being price traded inside ranges. In other words, price on average does not move in straight lines. This means that mathematically, if price doesn't move in straight lines 90% of the time, then if you are locking in gains systematically at each level 90% of the time, your trades, the winning ones, that is, will go green to red. You'll have a nice 7 or 8 or 12-point gain, and it will evaporate. Over time, those evaporated gains are life-changing, and if you are looking for those 10% of the time home runs on every trade, you will not only not catch the home runs, but by the time they happen, your capital will be massively depleted, and you will probably miss it anyway. The fix is level-to-level trading. A golden rule of price action is that it will nearly always take the most complex, trap-filled, difficult pathway from point A to point B, so that even if your target turns out to be right, big if, you very likely won't make money. When you start trading every day, you are competing against an army of institutional algorithms, largely coded by teams of PhDs in computer science or other STEM disciplines, utilizing cutting machine learning, with deeply verified edges that win much more than they lose. When you place a trade, this is what is on the other side. It stands to reason that someone has to do the losing. Typically, it is, among others, Always retail, because they're falling into this institutional web of traps over and over due to the fact they're overwhelmingly trying to predict what price will do, instead of just taking things one level at a time. Most days will, for example, will look something like this. If you give an average ES session open at 45.20, rally to 45.40, sell back to 45.20, fake below to trap shorts, rally to 45.36, take a hard leg down to 4,500, then set a low for a day or two. You want profit from not trading level to level. Any trading strategy intraday that looks like home runs on every trade and does not take profits on a level-to-level basis will statistically lose over a large sample, since most trades are not multi-level runs. My basic trade management strategy is therefore summarized as follows. Firstly, do not guess where moves will end nor assume any entry will result in a large move. Most don't. You don't know, I don't know, nobody knows what setup will result in a one-level move and fail, which will go for levels and reverse, or which will break and rally 100 points. The vast majority of moves only go 1 to 3 levels. A small subset go 3 or 4, a rare subset go 4+. Therefore, always lock in the majority at 75% profits at first level. From there, move stop to a little below break even, leave a 25% runner to go in case we trend. From there, lock in more at second level, leave a fully risk-free runner, and trail up stop, usually about 10% of the original trade for me for the final runner. Each runner can be seen as a lottery ticket that costs nothing, and every 15 or 20 trades, one will reward you with a massive payout. In the section below, I go into detail how to trail my stops. Do this on every single trade, regardless of what you think, regardless of how you feel, regardless of what you read on the internet, and you will not keep far more profits than ever before, but you far more likely to catch those home run moves via the runners when they do occur. 7. How do I set stop/trail stops? With regard to stop setting and trailing stops, my stop setting is based on 2 principles. 1. I do not use tight stops. Every trade needs ample space and time to work. 2. I do not believe in arbitrary stops. Stops must make sense technically. If I enter a 4,500 and there is support at 44.95, I will not put a stop at 44.95. It will go at 44.90. I want to give every trade a chance to work, and I will never stop out arbitrarily without a support being lost, nor will I stop out due to my interpretation of price action once I am in the trade. Once I enter, I am fully committed until a stop or target hits. Every trade gets ample space, and all the time, it needs to work. 15 points is maximum risk for any given trade. In other words, the absolute maximum size loss I will ever take on a full-size trade is 15 points. This is a hard rule, and there is no exceptions, under any circumstance. I practice. My stops usually do come under this value though, often in something like 7 to 11 point range. If my target is 10 points, a 7 to 11 point stop works out in an initial R/R of 1, and this is perfectly fine, and runners will often ramp the R/R further. If you have an R/R of 1 and a 60 equals 65% win rate, you have a nice profitable system. As R/R increases, win rate does drop. As readers know, I do tighten this as a trade goes on based on technical factors. For example, if some obvious low forms on a 15-minute chart, I will drag it up below there. But if I am 10 to 15 points green, the first will never take full stop out, and if I am close to target and it fails, I will never take a loss on a trade, no green to red, and will try to get out several points above break even. I won't put 10 points of profit at risk because price comes 1 point from a target. It is important to realize wider stops do not mean larger risk. Risk is a function of position size, not of stop size. I manage risk via this smaller position size, and a 5-point stop and 15-point stop trade is 3x smaller, etc. Information on how my stops can be found in this newsletter. 8. The core difference between amateur and professional traders is amateur trading is largely about predicting. Professional trading is about resting. My trading, and all professional trading, is about resting to price action, not predicting it. Nobody knows where price is headed, nor can anyone predict the precise pathway price will track intraday. Professional and profitable trading is about knowing levels, Knowing the entry setups, having a disciplined system for managing trades, and being prepared to react in real time to whatever price does, up, down, or sideways. A good trader always has a lean or base case, but is prepared to react to whatever scenario presents, allowing them for profitability regardless what pathway price chooses. One could start the day with a high level of bullish confidence, but if a critical support fails and bear case triggers, it means it's time to get bearish and short. Your lean/bias should never prevent a profitable session. Level to level, one move at a time, reset bias, and let price choose whatever path it wants. My core setups. 9. My core pattern is failed breakdown/breakout, and this comprises over 70% of my entries. Very important information on failed breakdown strategy found in this newsletter. Below are real-time examples of the pattern from prior newsletters. The failed breakout/breakdown setup is premised on the fact that the majority of breakouts and breakdowns are traps. Price absolutely loves to break down a support, trap those chasing, then reverse and squeeze the other way. Breakouts are therefore exceptionally hard to trade and take enormous amount of skill and screen time to recognize the conditions that are likely to produce sustained versus failed ones. These are my favorite pattern because it puts you on the side of institutions rather than on the side of chasing breakouts and getting trapped. Markets look for liquidity, and the best way to do that is wait for a breakdown, trap shorts chasing, grab stops on the longs, then reverse. Mastering the setup allows you to benefit from this effect, rather than be a victim of it like the majority of retail traders. Institutions have a set bag of tricks they use to enter the market, and the failed breakdown is number one on that list. Fortunately for institutions, liquidity hides in very predictable spots, and it just so happens to be at spots that most retail traders have their stops, or start FOMOing into short. If you are an institution and want to enter a massive long order, the best way to do it is use a little capital to flush a major support/cluster of lows, then buy from all the stops hiding underneath and all the traders FOMOing and thinking the market is going to crash. Then the market can squeeze higher. The average retailer loses because they constantly get trapped. They chase a long based on a breakout with FOMO and it reverses. They chase a short based on breakdown with FOMO and it reverses. They put in a stop in and it gets flushed, then price rallies, etc. This is how institutions make money. They seek liquidity, and if you cannot clearly see the trap before you get into a trade, you're probably going to be the one getting trapped. The failed breakdown flips the script here and exploits liquidity seeking, so you are trading alongside the bulk of institutional money after the trap, rather than being victimized by it. Failed breakdowns involve 4 basic criteria. The more the criteria are maximized, the higher the win rate of the failed breakdown, and these setups can vary from a 40% win rate to a 80% or 90% win rate, depending on how criteria are met. 1. Price must put in a significant low. This is the most important criteria, and if this is not present, there is no failed breakdown. A significant low is usually a daily low or a major multi-hour low. It cannot be any random low. The initial low has to produce a rally that is technically significant, strong, and obvious on the chart. When you look at a 15 or 30-minute chart, the low should produce a bounce that you would have liked to trade, and it should ideally run for several levels and defend for several hours. It also does not have to be a single low, and multiple lows connected by a horizontal or even sloped trend line at the same level also works. Remember that a low is a pivot. It is a point where a pullback ends and a rally begins. A good litmus test is if you look back on the chart a few months from now, the low should jump out. A quick little bounce is not a significant low. If this criteria is met, you can move on to the next criteria. 2. The low occurs at a technically significant spot. Ideally, a major trend line or horizontal support or prior area where price broke out and is now backtesting. It can't just be a random spot on the chart and must be an important area that was previously significant if you look to the left of the chart. 3. Price puts in a convincing loss of that low, enough to trap shorts and run stops on longs. It should look quite dramatic in real time, as if you can see traders being trapped. Ideally, 2 to 11 points is a good range for how much price should lose the low by. Generally under 2 points is questionable if it is a failed breakdown, and this borders just on a test of a level. Over 11 points, there is a risk of a real breakdown. Instead, of course, failed breakdowns where price loses the low by over 11 points and recovers happen all the time, but one needs to be a little more patient with these. Instead of rushing in, make sure price is accepting the level. If the level fails by a large quantity, there's a risk the lows could just backtest and price could resume lower. Be patient. Wait for the price to magnetize at around the lows, then get in. It takes screen time to recognize these in real time. 4. Price reclaims the low. Trigger is a little above the low being reclaimed, depending on context, perhaps 1 to 4 points. The above is inverse for failed breakouts. It is important with failed breakdowns not to rush. You can give price a little time to make sure price is actually accepting around the former low. You do not just want to blindly rush in a millisecond after price pops above a low, because often I can just reject and head lower. Give it a little time to make sure the price wants to be there. Generally, the lower the volatility, the more time you need to give price. Low volatility, you can usually wait 5, 10, 15 minutes, sometimes even hours. High volatility or after data, you have to get in quickly. In addition to this, the deeper the failed breakdown, typically the more time one needs to give. This is especially true if price flushes a low by more than 11 or 12 points. Unless it's an absolutely extreme volatility session, you need to give price time around the lows before you get in. Let price settle and stabilize at the zone. If it's a shallow, quick grab a low, one can usually move quicker. How long you need to wait to enter is a function of the variables of volatility and below the low that price goes. As stated above, these conditions are not all mandatory to take a failed breakdown. Markets are probabilistic. There will be failed breakdowns that meet the criteria perfectly that don't work. There will be others that meet one criteria and result in 3-day moves. But the probabilities favor the setups that stack most criteria. They are decision-making tools. For this setup, the stop goes several points below the lowest low, perhaps 5 points for me. The buffer used will vary depending on context. It is why screen time is invaluable. Below are some examples of how this looks both in its textbook variety and then in real-life examples. The last chart shows a series of failed breakdowns that occurred daily from January 5, 2024 to January 10, 2024. This is a good demonstration of how these setups on context and how they structurally, which in turn results in deviations in quality. The only way to internalize the setup is to see hundreds of them, and I try to expedite this process daily by sharing as many as possible in the newsletters. A variation of the failed breakdown, the level reclaim. There is an advanced variation of the failed breakdown which is also worth pointing out. New traders who have not mastered the classic failed breakdown should not trade level reclaims unless specifically specified in this newsletter. If you have at least 1 or 2 years of success trading failed breakdowns, though, one can broaden the criteria. A level reclaim operates on the same principle of the failed breakdown. A major level flushes and recovers, but it may lack those first 2 defining features above. Namely, there may be no significant isolated low. It could just be an obvious horizontal support line that has been well tested, respected, but have already flushed and recovered many times. Secondly, the low may not grab below by 2 to 11 points and recover. Instead, price could lose the level by large margin or stay under it for many days. A level recovery is essentially just a broader variation of the failed breakdown. It lacks that defining shape of the standard failed breakdown where you have a clear low, a quick flush of the low, and recovery. It can be considered an other category for traps that don't meet the standard failed breakdown requirements. When price returns to the breakout level, on the first test, there is a strong tendency for price to rally. On subsequent backtest, that probability drops successively until the level eventually caves through. There is no standardization to these probabilities, but as an example, the first backtest may hold for a strong move, the second may hold for a strong move, the second may hold for a strong move, then the third time price will fail. The bottom line is, when breaks out, often comes backtest a breakout level. On the first test, often a good long. Conversely, when price breaks down, it often backtest the breakdown level. On the first test, it is often a good sell. The breakout level can be many things, a horizontal line, a zone, or a trend line. Below are 3 examples. The first is a straightforward horizontal level backtest, the second is of a bull equals flag backtest, and this one is a little more nuanced, and the third is a triangle breakout and backtest. A backtest trade has 4 steps. 1. A high momentum, strong, obvious breakout. 2. A clearly defined zone of messy highs. 3. Price needs to come back to retest the zone. 4. Buy the retest on the first test. Sometimes it holds on second and third test as well, but the odds drop.